LBR LBO Debrief.
Hi, morning everyone, and thanks Lakshman for inviting me once again. I'm not sure whether this is going to be as exciting as last year, but what I'll try to do within the purview of the time is walk you through the macro trends of the emerging Asian economies, and after that touch upon some of the challenges and opportunities the region is experiencing given the whole global dynamic setup both Paul and Saurav alluded to. And after that, if time permits, we'll talk about some of the key countries which Sri Lanka are important, countries which are important to Sri Lanka. So let me just start with that. Key themes, what we have been seeing in the region, and in fact, since we last met, a lot of the balance of risk in the region has tilted towards downside. And when I say that, I was just refer to what Saurav and Ralph mentioned with respect to sluggish Chinese economy, and then we had Brexit around middle of the year, and then followed by the US elections. So all that led to a lot of political and policy uncertainty. But despite all that uncertainty, what we saw is that emerging Asian economies, you can see the red bar on the chart on the left, have been holding steady. And the Asian economies are not just holding and steady and growing at about 6 to 6.5%, they are actually have outperformed most of the other regions. On the right, you can see a slide which tells you some economies like Myanmar, India, Indonesia are doing better than the rest. But overall, the momentum in the region remains to be quite buoyant. So what is that worked despite all the pessimism in the global economy which we are experiencing? So what is that which worked for these Asian economies? So when we as the drag from the lower commodity prices moderated towards early this year, and as the Federal Reserve kind of toned down its expectation to start tightening, it gave a lot of time and space to Asian economies to undertake key structural reforms. Some of the economies like India, Indonesia have deregulated oil prices, which has helped them correct the fiscal balances. Definitely lower oil prices has also given them that fiscal space. Together, and not just to address the fiscal balances, but this has also helped the current account. As you can see, there has been a sharp improvement in the current account balances of these countries, which has provided them stability and helped them give higher forex reserves than what it was in probably 2013 when we first started hearing concerns about Fed tightening. But despite improving stability on the macro factors, domestic demand in the Asian economies has remained quite subdued. The chart here, I'm trying to picture the retail sales, the retail spending of the consumer. It is for emerging Asian economy, excluding China. What it is showing you, if you can look at this, if you look at this leg of the one highlighted it in the red zone, it kind of tells you the story that there has been bouts of uptick, but it's not been steadily or consistently rising. Why is that? There have been countries like Sri Lanka, India, Indonesia, where you have seen either public spending support, either by way of higher salaries or by way of tax incentives to, let's say, buy automobiles or houses, which have led to these upticks in demand, but there has not been a steady improvement in either sentiment or consumption behavior of these economies. On the external side again, you can see the red bar. It shows you the emerging Asian exports. Exports have in fact remained subdued since 2012. And if you actually look at the recent picture, there has been a very interesting trend to be noticed since 2012. If you see beyond this orange dotted line, you see a divergence between the blue line and the red line. What is the blue line telling you? The blue line captures the developed markets' industrial output, while the red line is your emerging Asian exports. You see there is a clear decoupling and divergence happening from 2012 onwards. And despite a steady growth in the industrial activity in the developed markets, you see exports continuing to contract in the Asian economies. So the question to ask right now, is this decoupling or divergence a structural phenomena, or is this a cyclical story which probably will revert back once there is a stronger growth in developed markets? So if we think about the reasons why this divergence has happened, I mean, it clearly tells you that despite periods where you have had steady industrial production in the developed markets, you haven't seen much of an traction in the exports. So it's clearly not cyclical. But what has already also been happening, and Ralph also kind of talked about it in brief, is the structural changes in the economy. We've seen most of the developed markets resorting to some kind of import substitution. It's not just changing the country from where you're importing the goods from, but it's probably also indigenously producing some of the commodities. For example, US has become over the last 5 to 7 years much less dependent on imports for gas and oil, and there has been much higher production within the economy. Similarly, US has started importing a lot of automobile-related inputs from Mexico, and what earlier used to be going from Thailand and Vietnam. Apart from these import substitution, there could be possible underlying import restrictions like quality control, and especially you see these phenomena coming up during periods of low global growth and sluggish domestic economy. We can call it nationalism or global anti-globalization, but these could be the possible factors which have led to this decoupling. So what does this mean for the region? If you look at the chart on the left, it tells you clearly more than 60% of the region's exports are going to the developed markets. Well, there is a good news and the bad news on the right chart. What it clearly shows you, if you look at the blue bar, is that the exports which are going to the developed markets are showing an uptrend. There is an uptick, but while the exports which are going to emerging Asia and China are continuing to see some contraction in the growth. Going into 2017, if we expect the global economy to grow relatively better than what we saw in the last 2 years, and especially US, with the president-elect talking about a fiscal stimulus and higher growth in US, then there is a possibility then that this blue line uptick will definitely help the regional exports. But what we saw here, the big disconnect, it possibly can mean that despite a higher growth in the developed markets, you may not see or you may not be able to benefit fully from the positive spillovers of a higher US growth or a higher growth in the developed markets. So what has this basically meant for the capex cycle? You've had weak aggregate demand, you've had weak external demand for almost 4 to 5 years now. And on top of that, weak capacity utilization, expectations of returns for the private sectors have been low, despite a positive real rates in most of the regional economies. This is on the demand side, and if you look at the supply side of the story, most of the banking sectors have been sitting with bad assets, and the NPLs in the region are almost as in some of the countries like India, Sri Lanka, Bangladesh, are as high as 8 to 11%. So both the supply side and the demand side has kind of constrained the private sector to undertake fresh capital investment. If you look at the bar on the left, it shows you the capex growth, which has happened in the region, and it kind of maps a similar story what we saw in the private consumption. It's looking subdued. There have been periods of upside, but there is no consistent uptrend similar to what we saw in 2004 or even prior to global financial crisis. I mean, there are exceptions, but we can talk about them later, time permitting, in this phenomena. Countries like Philippines and Indonesia even India to a certain extent. But the global story so far, I mean, the broad story so far is of a muted private spending growth. Just to break this cycle of expectations of low growth leading into low private capex, and this further seeping into a lower productivity and low potential output, the policymakers have been trying to break this, negative vicious cycle, if I may call that, by injecting much more by monetary easing, cutting down interest rates, increasing capital expending. But there is obviously a cap to how much ammunition or the fiscal space the governments in these countries have. If you look at the chart on the right, it shows you some of the countries, and Sri Lanka is actually one of the weaker ones here, where revenue to GDP ratio is quite weak, and that kind of limits the amount of spending the government can undertake to crowd in private investment. Well, all is not gloomy in the region. Thanks to the easy monetary policy in the developed markets and steady growth rate in the region, capital flows have been coming in, and quite steadily in some of the countries especially. If you look at the chart on your left, it tells you a picture of how the gross capital flows have been in 2015. Clearly, East Asia, and this includes China here, so you can, you know why it's such a big chunk. But East Asia has been a dominant receiver of capital flows. And here, capital flows includes both bond, equity, and loan, and the loans. Followed by LAC, and then you have MENA and ECA. If you look at 2016, and this includes data up till October, East Asia continues to be the largest receiver of capital flows, but the incremental increase in flows has actually gone mostly to LAC and MENA and ECA, and that's because of economies like Brazil moving up and improving from a recession to a much more stable growth rates. Argentina also contributes a lot in terms of a better political scenario, and hence the a positive sovereign issuance. But broadly, Asia continues to be a strong receiver of capital flows. If I zoom in into countries here, and it shows you how the foreign direct investment in some of the key economies which matters to Sri Lanka has been. India, Indonesia, Vietnam clearly are the investors' favorite, and we all know why, because these are the countries which not just have been registering high growth, but they're also the ones who've been actively undertaking reforms and moving towards better and a stronger macro fundamentals. The chart on the right tells you where these FDI flows to the regions are coming from. Interestingly, if you look at both the blue and the red bar, the blue bar tells you how the flows were in 2011, while the red bar tells you how it has been as of today. Clearly developed Asia, and this would include countries like Singapore, Malaysia, Australia, New Zealand, are the ones who have been actively contributing to FDI inflows. China clearly has been a good contributor. But US, Japan, and even the emerging Asian economies, the inflows from these regions are steadily declining. So what does that mean for the region? What are the challenges we kind of anticipate going ahead into next year? One of the biggest, and probably in the order of chronology, would be the US Fed rate hike. Market is expecting almost a hike in December and probably 2 to 3 hikes in 2017. I think more than now, whether the hikes are going to happen, it's about how many and how aggressive they are going to be. But having said that, the region this time around is much more stable, much less vulnerable than what it was in 2013. And we saw in the initial few slides why is that. But despite that, some of the countries which have larger current account deficits, even country like India, and Indonesia, which have still deficits on their current account, will be more vulnerable, because if there is an aggressive pace of hikes, you would see capital inflows, some reversal or moderation in capital inflows, and thus the external account to that extent, and even the currency would be vulnerable. Following Fed rate hike the next big concern for the region would be China. Countries like Myanmar, Mongolia, Cambodia, which are highly dependent on China for not just exports and investments, they obviously would be very vulnerable if there is a sudden change in trajectory in Chinese growth. But having said that, China, the way it is transitioning, and as we saw in Ralph's slide, from investment to a much steady consumption-led economy, it is also kind of offering a support and a cushion to the region by way of providing a consumer for the goods which the region is producing. And it's also providing a lot of tourism inflows to countries like Thailand, even Sri Lanka, India. So that kind of support is definitely still China is providing as it is undertaking the transition. From short term to medium term, what are the big risks? Clearly, the expectation of the new mediocre. And what do I mean by the new mediocre? Expecting lower growth for a longer period of time is what the world is probably getting much more attuned to and used to. We are seeing US growth almost at 1.5%. Euro region is still kind of struggling, and it's still in a monetary easing phase. What this basically means clearly, yes, that given that Asian economies are highly export dependent on these economies, there will be longer period of low capex, low demand to expect from here on. But it also means that there would be continued dependence on easy monetary policy, easy money in the global liquidity system, and which could affect the asset prices in Asian economies, and obviously there's a spiral effect there on inflation, on commodities, on housing prices, on the currency. So that all needs to be weighed in as to how much the pace of growth of is likely to be expected going ahead. Sort of talked about climate change, so I'm not going to refer to that. But escalation in geopolitical tensions and the change in the policy and political dynamics is something which is very critical. And referring to that, I probably will take one deep dive into this thought and talk about what the Trump victory would probably mean for Asia. I'm sure this is one question which everybody has been playing in everybody's mind in the last couple of weeks. And it is much more difficult to answer this question, I think, even for somebody close to Mr. Trump. But I would rather say it is too early to tell. But going by what the voice from, or what the promises the president-elect has made, we can draw certain inferences. But before I jump to inferences, I would like to say that in the last couple of weeks, whatever noise or whatever direction we have heard, it seems to be much more moderate than what the president was referring to in his campaigning days. So I think there are going to be a lot more checks and balances, and both systemic and personal within the US bureaucracy to inhibit him from taking very extreme measures which probably were proposed during the campaigning times. So how is the Asia policy from the new president going to look like? I think it's largely going to be defined around the need to manage the rise of China. And as the president-elect has talked about withdrawal of US troops, about countries having to pay for security, and encouraging some of the big giants in the region to develop their own nuclear arsenals. I think that's still less of a worry, but if it comes to, it will cause a lot of internal tensions between the region and divert the focus of policymakers from undertaking reforms and the necessary steps to uplift their economies and more towards how to allocate more defense budget and how to liaise in with the stronger countries. So that's never a good idea to start with. But on the economic side, definitely, if the U.S. starts, the growth in U.S. is kind of picking up on a much more stronger basis. The positive impact on the region is always good. But we never know how much the spillovers are going to be. As we have seen in the past, I mean, in the last couple of years, there has been a clear decoupling, and the internal focus and the new nationalism will probably drive the economic spillovers more than the economic opportunities. The two key things which are of concern to the region are clearly jobs outsourcing and the immigrant issue. We don't have much clarity again as yet on how the president-elect is going to be, taking the steps on these issues. But economies like Philippines, even Sri Lanka, India are the ones who are deriving a significant proportion of their GDP from employees or jobs-based linked to US. So that's like going to be one area of concern for the region. So what does it mean for Asia in terms of opportunities given the new dynamics situation? The region continues to be rich with young population. The demographics are much better. Income levels are rising. The skill levels and the education levels are quite good. There's an English-speaking population base in the region. So definitely it's good for the consumption and the demand-based sectors. It's also good for the health, education, pharma, and the entire value chain. But leaving aside the sectoral part of opportunities, what I would like to rather focus on and see these countries draw upon is the opportunity to reform. We've had enough time in the last couple of months, as the Fed did not hike, to undertake significant and difficult reforms. And from here on also, whether TPP happens or doesn't happen, there is an opportunity for the smaller countries in the region to get together and push to the reforms with the window of opportunity which is available. Do we have time for the country snapshots? Okay. So I'll quickly walk through some of the countries which are of relevance to Sri Lanka. India, as I mentioned earlier, has been one of the brightest spots in the emerging Asian basket. It has been growing steadily at about 7.5%. But the recent move by the government to demonetize the currency, and if I can call it in a much more laymanish manner, the change in currency is going to impact a near-term and a short-term growth and the spending in the economy. But if you look at it a broader term, it is very bold and a strong reform aiming towards counterfeiting and trying to institutionalize a lot of parallel economy which was existing in the country. The fiscal position in the country is quite strong. The deficit is about 3.5%, and that's going to be the target of the government is likely to be met. As I said, external account is also looking quite favorable. We expect the deficit to be close to about 1% of GDP. Despite the exports contracting, there is a support from lower import demand and lower aggregate demand. But despite all the good things, private capital spending continues to be the weak link in the economy, and that's largely because of strong and high debt accumulation in the corporate sector, along with the high NPL ratio in the banking sector. This is one slide which just quickly tells you what's going right and what's still work in progress in terms of the policy, in the policy domain. We've seen material progress on delivery of some of the reforms like goods and services tax and demonetization of the currency, clearance of the stalled projects, liberalizing FDI rules. But I mean, there are still some way to go in terms of clarity on Make in India, clarity on manufacturing, clarity on labor reforms. Moving to the next country, what I've tried to do, it's very difficult to summarize one country in one slide, what I've tried to do is just pick up one chart which kind of captures the story and the key message for the country. And for Bangladesh, for me, this was something which kind of stands out. Remittances, which have been a strong supporter of the consumption in the economy, have been steadily declining. And if you see the red bar, it tells you how in the recent last few quarters there has been a contraction in remittances. But despite that, we have seen the ready-made garments export, which is the blue line, kind of holding steady and supporting the overall current account. The key red flags in this economy are banking sector. The NPLs are close to about 10%, and if you add on top of that the stressed assets, so close to about 7.5%. So you're looking at almost 18 to 19% of stressed assets sitting in the public sector, banking sector. So that's not a very good news going into a global situation where there could be monetary tightening. Indonesia, the economy continues to be supported by private spending and also public investments. The cabinet reshuffle and incoming of Sri Mulyani has been very positive, and it's kind of seen as a positive help in implementation of the reforms which the country plans to bring in. The GDP growth is kind of steady at about 5.5%. But the big red flag is the fiscal. The deficit is close to 3% and the target, and it's going to be matched thanks to the tax amnesty flows. But on a longer term, on a structural basis, the country needs to undertake and incorporate reforms which will help boost the tax reforms on a much more structural basis. And this is what the chart is telling you, that the growth has been contracting, and there has been a parallel linkage with the tax revenue flows in the economy. Myanmar has been a hot favorite in all the conversations and discussions whenever I go and meet people like you. And one of the big questions is whether there is a hype around the country or there is actually any meaningful growth coming in the economy. As an economy which is newly opened up to the private sector, there's definitely a lot of potential, and you see that in the growth numbers, which is almost about 8.5%. But in a very short time, there has been a lot of investment and a lot of activity happening without proper due and checks in terms of institutional reforms and checks and balances in place, which is kind of causing a little pressure on the economy. And you've seen current account deficit as high as 8.3% and even pressure on inflation building up. The transition on the political front has been pretty smooth, but there are concerns about how experienced the new government is in terms of handling both the politics and the bureaucracy. The recent news and issues around ethnic minorities has been of concern to foreign investors, so that needs to be clearly managed. Thailand, okay, 1 minute. So Thailand has been affected by the king's demise. This is going to affect, at least in the next 1 to 2 years, and slow down not just domestic consumption, but also foreign investment, because you don't expect much of decision-making happening in the next 1 to 2 years till the elections happen. And thus, you see a kind of steady growth of about 2 to 3% in the next few years. Lastly, Vietnam. Vietnam has also been investors' favorite, and there have been some things the country has been doing right. The growth has remained at close to about 6 to 6.5%. Credit growth continues to remain high, but again, the pressure point of weak banking sector asset quality is still to be watched out for. Most of the bad NPLs are sitting with the asset management company, but that's still a red flag for the economy. Lastly, Sri Lanka. There has been a conversation about whether Sri Lanka needs to look east or look west. There's clearly a linkage and dependence on both the east and the west in terms of how Sri Lanka draws its forex reserves from. But I think in a very short and a crisp fashion, I would rather like to summarize it by saying we can talk and debate about whether the country needs to look west or east, but the bigger question is we need to look inwards in terms of how we are structuring and reforming and preparing ourselves once to improve the risk profile of the country. Thank you.
LBR LBO Debrief.